Audio Jungle.
Hi, first of all, I will tell a little bit about the foreign exchange in international trade. Foreign exchange is the conversion of one country currency into another country currency. It was created in order to facilitate the flow of money derived from international trade. For example, if we want to purchase goods in Japan, we will convert the ringgit Malaysia into yen in order to purchase those goods. Businesses might receive foreign exchange and enter the market to convert the money back into their domestic currency. Next, for the foreign exchange market, foreign exchange market is an established institution for buying and selling of foreign currency. Exporter will sell the foreign currency and importer will buy them. In this foreign exchange market, it will determine the foreign exchange rate for global currency. The meaning of foreign exchange rate is foreign exchange rate is a price of one currency in terms of another currency. Using exchange rate, we are able to compare price of goods, services, and assets quoted in different currency. The main relationship between the exchange rate and international rate is the manner in which fluctuation in exchange rate affect the value of import and export. On the nation level, a country with a weaker currency is at disadvantageous when trading with a country with a much stronger currency. Exchange rates are determined in foreign exchange market where all the foreign exchange transaction takes place in that institution. We have listed down the six important of foreign exchange in international trade. The first important is foreign exchange is as a solution that allow country to issue their own currency and to conduct their own monetary policy. Second is allowing the international trade to take place by offering a way of exchanging one currency for another based on agreed upon or market determined exchange rate. The third important is foreign exchange rate helps to determine national economic health and hence the well-being of all people residing in it. Number four is foreign exchange helps to determine the value of certain currency in relation to another currency. That is to specify the quantity of unit of one currency to be exchanged for one unit of another currency. Number five is it can encourage the flow of cash between countries. We can identify countries with surplus liquidity and those in need of liquidity. The last important is to finance international trade whose transactions represent a significant part of the currency market.
Assalamualaikum and good day everyone. My name is Nazira binti Asri, metric number 269520. Okay, I will discuss the impact of foreign exchange rate movement to the export proceed and import payment. Basically, foreign exchange rate is the price of one currency relative to another currency, and it is determined by foreign exchange market. Okay, so Malaysia company receive payment from the importer in the currency of the import country when exporter is from Malaysia. Likewise, Malaysia importer can be billed by foreign seller in their national currency. Okay, next part. The ringgit Malaysia are stronger when the exchange rate is higher. Okay, for foreign consumer, Malaysia goods and service become more expensive, so it's cost them to buy less Malaysian goods. Product price in ringgit are more expensive in foreign country because it take more of a foreign currency to purchase strong ringgit. However, the price of import product and services are becoming more affordable to Malaysian consumer. As a result, the export will decrease and import will increase. Okay, when the exchange rate is low and the ringgit Malaysia is weak, it benefit Malaysia exporter and foreign consumer. This is because the price of Malaysia product drop in foreign market. So it encouraged them to buy more Malaysia products. Product price in ringgit are more cheaper when sold to other country because it takes less foreign currency to purchase the ringgit. However, the price of goods and services from foreign country increase for Malaysia consumer. This means that Malaysia consumer and Malaysian company that import goods have less purchasing power. So as a result, the export will grow, but the import will drop.
Assalamualaikum and hi. My name is Nurul Nadebet Yusof and my metric number 269707. So now I would like to present about the foreign exchange risk. Foreign exchange risk refers to the adverse effects that anticipated exchange rate change can have on the value of the firm. There are three types of the foreign exchange risk, which is transaction risk, and economic risk. Transaction risk refers to the risk faced by companies when making financial transactions between jurisdictions. Then, transaction risk refers to the risk faced by companies headquartered in the country but conducting business in a foreign jurisdiction, and the financial performance of the company is expressed in its domestic currency. Lastly, the economic risk refers to the risk that a company's market value is affected by inevitable exposure to exchange rate fluctuation. Ways to mitigate the foreign exchange risk in international trades, which is two ways. Firstly, hedging techniques. Exchange rate risk can be significantly reduced through the use of hedging techniques. The simplest solution is to invest in a hedged investment such as hedged ETF. Hedged ETF fund managers can hedge forex risk at relatively low cost. The second way to mitigate the foreign exchange risk at international trade is invest in countries with a strong currencies. If someone want to invest at the national level, they can find countries that have strong and rising currencies. In other words, this currency is stronger than the domestic currency itself. If foreign currency continue to rise, investment will be more valuable in currency.
Assalamualaikum, my name is Nurin Mastura binti Sainuddin and my metric number is 271271. For my part, I will give further explanation on how to mitigate foreign exchange risk in international trade. So I will explain more about foreign exchange hedge. A foreign exchange hedge, basically also called a forex hedge, is a method used by the companies to eliminate or hedge their foreign exchange risk resulting from transaction in foreign currency. This is done using either the cash flow hedge or the fair value method. The accounting rules for this are addressed by both the International Financial Reporting Standards and by the US Generally Accepted Accounting Principle, as well as other national accounting standards. A foreign exchange hedge transfers the foreign exchange risk from the trading or investing company to a business that carries the risk, such as a bank. There is cost to the company for setting up a hedge, because by setting up a hedge, the company also forgoes any profit if the movement in the exchange rate will be favorable to it. So, when companies conduct business across border, they must deal in foreign currency. Companies must exchange foreign currency for home currency when dealing with receivable and vice versa for payables. This is done at the current exchange rate between the two countries. Foreign exchange risk is the risk that the exchange rate will change unfavorably before payment is made or received in the currency. So, for example, if a United States company doing business in Japan and it is compensated in yen, that company has risks associated with fluctuation in the value of yen versus the United States dollar. So moving on, there are two common hedges. A hedge is a type of derivative or a financial instrument that derives its value from an underlying asset. Hedging is a way for a company to minimize or eliminate foreign exchange risk, which I have explained before. So there are two common hedges, which is the forward contracts and option. I will move to the forward contract first. I will explain about it. So a forward contract will lock in an exchange rate today at which the currency transaction will occur at the future date, while an option will set an exchange rate at which the company may choose to exchange currency. If the current exchange rate is more favorable, then the company will not exercise this option. There are main difference for these two common method, which is between the hedge method is who derive the benefits of a favorable movement in the exchange rate. With a forward contract, the other party derives the benefits, while with an option, the company retains the benefit by choosing not to exercise the option if the exchange rate move in its favor.
Assalamualaikum warahmatullahi wabarakatuh. My name is Putri Nur Amira binti Muhammad Atas and my matrix number is 271911. So now I will continue my part. A forward contract is a foreign exchange agreement to buy one currency by selling another on a specific date within the next 12 months at the price agreed on now, known as the forward rate. By entering into this contract, the buyer can protect itself from subsequent fluctuation in the foreign currency exchange rate. The intent of this contract is to hedge a foreign exchange position in order to avoid a loss or to speculate on the future change in an exchange rate in order to generate a gain. Next, forward contract has a pro and cons. The pro of forward contract is forward contract reduces your exposure to currency fluctuation and exchange rate change. By locking in a rate now, you can plan ahead with certainty, knowing what your cost will be for buying and selling overseas, particularly helpful for small businesses who need to keep cash flow predictable and easy to manage. While for cons, by locking in a forward rate, you are committed to it, even if the exchange rate change in your favor, meaning you could have saved more money if you opted for a spot contract at the time you needed to make an exchange instead.
Next, I will present the part of introduction to FX option. Okay, what the meaning of FX option? Okay, a foreign exchange option or currency option is a financial derivative that grants the right but not the duty to convert money denominated in one currency into another currency. It's at a pre-agreed exchange rate on a defined date. The majority of solution will give you with complete protection from currency market fluctuation. FX option are like forward contract may allow you to respond quickly to market changes. FX option may provide your business with a greater degree of flexibility than other risk management tools. The difference between FX option and traditional option is that in the latter case, the trade is to give an amount of money and receive the right to buy or sell a commodity, stock, or other non-money asset. In FX option, the asset in question is also money, denominated in another currency. For example, a call option on oil allows the investor to buy oil at a given price and date. The investor on the other side of the trade is in effect selling a put option on the currency. To eliminate residual risk, traders match the foreign currency nationals, not the local currency national, as the foreign currency received and delivered do not offset. How does the FX option work? Okay, with an FX option, One party with either option holder get the contractual right to buy or sell a fixed amount of currency at a specific rate on a predetermined purchase date. Upon contract formation, the holder or the buyer has to pay a fee to the seller for acquiring the option. This fee is called premium. FX auction contracts are typically traded through the over-the-counter OTC market, fully customized and can expire at any time. In the spot option market, when you buy a call, you also buy a put at the same time. FX auction can be used as a direct investment tool for expressing a view in the market or as a hedging tool in conjunction with existing position. FX auction could play an important part in your future investment. FX auction failure make them extremely useful for hedging FX risk, which when the direction of movement in exchange rate is uncertain. It also useful tools which can be easily combined with spot and forward contract to create bespoke hedging strategies. There are two main types of foreign option available, which is call and put option. A call option gives you the right to buy a currency, while a put option gives you the right to sell a currency. Once you have placed a call or put option, you then have the option to buy or sell these currencies later. When you buy a put option, your total liability is limited to the option premium paid. That is your maximum loss. However, when you sell a call option, the potential loss can be unlimited. However, if you are betting on volatility coming down, then selling the call option is a better choice.
So, the formula to calculate forward rate is spot rate plus forward margin. Okay, for forward margin, it can be positive or negative sum depending on rate of interest of the currency involved. Okay, to find forward margin, we can take spot rate times interest differential between two specified currency and times tenor, which is the number of forward day. If forward rate is a premium, forward point is added to spot rate. While if the forward rate is a discount, forward point is deducted from spot. Okay, for forward margin, it is actually the difference between the spot rate and the forward rate. If the forward margin is positive, it shows that it is forward premium. The forward price is higher than spot price. If the forward margin is negative, it indicates that it is forward discount. So the forward price is lower than spot price. Thank you.
Okay, why do we calculate the forward rates? The forward rate is calculated from the spot rate and adjust for carrying costs to determine the future interest rates. That equates the total long-term investment return with the short-term investment large strategy.
So moving on, my group members already explained about the definition of forward contract. So we will be moving on to the next calculation example for forward rates by using a one-way quotation. One-way quotation is where only one rate, either buying or selling, is quoted. Given by above way quotation, we know that Euro is heading for a discount market since Euro is stronger against Malaysian Ringgit. Thus, forward 90 days buying rate will be spot rates minus swap points. From the data given, we only need to subtract the spot rates with swap points. So, from the spot Euro or Malaysian Ringgit 4.8865 multiplied by 6.35% 3 months Euro deposit rate minus 3.75% 3 months Malaysian Ringgit deposit rate, and it will be multiplied with forward 90 days buying rates divided by 360 times with 100. We will get the final answer, which is 4.8547. The calculation shows that in discount market, forward buying rates lower than the spot buying rate with difference of 0.0318, representing that the expected future movement in exchange rate brought about by interest rate differential between Euro and Malaysian Ringgit. In the above case, since euro deposit rate in spot market is higher than the Malaysian ringgit, the movement either upward or downward. For this case, it is downward. The above way calculation is just a simple calculation, shows that interest rate play the key role in determining the forward rate.
Next is the application of forward contract in international trade. Based on a picture above, a leading beverage company entered into a contract with a coffee estate for exporting 10,000 kg of coffee beans 3 months from now. The current price of coffee beans is Indian rupee 500 per kg. However, the estate is concerned about the declining coffee price and want to ensure that they make sizable profit from the deals. Hence, the estate entered into a forward contract with a beverage company to sell the 10,000 kg coffee beans after 3 months at a rate of Indian rupee 480 per kilogram, irrespective of the market price at that point. After 3 months, the beverage company will procure the same amount of a coffee beans from the estate at the agreed price as per the forward contract. There are 3 possibilities. First, if the current market price is less than a contract price, the beverage company make a potential loss. If they not enter into the forward contract, it could have procured the same amount at the market price. In this case, the estate saved itself from eroding costs. Second, if the market price is greater than a contract price, the estate made a potential loss since they could have sold the beans at the increased rate had they not entered into the hedge contract. Third, if the contract price is same as a market price, in that case, there are zero potential profit or loss into the both parties.